Okay, traders, welcome to part 2 of our video series on how to establish trailing stops. Okay, so quick review. Basically, on the first video, we talked about analyzing how the markets really move, coming to grips with the reality of that, accepting it on a psychological level. Then we talked about the principles that come out of that, basically that we never know when we're going to get a super trend and the market's going to run. But we do know from analyzing the market over time that that is not the norm, and therefore we can't count on that. If we do want to catch those super trends, we have to use very, very wide stops. And that we did go over just really one rule, translating those principles to rules, and that was that we would use our longer term cycle indicator as a trailing stop. And basically what that amounts to is, and let's go back over here where it was, our entry, for example, let's go all the way back to our entry and show this again. So our entry is when we get a break of the cycle high, we get a hook on the indicator, we get a mini divergence preferably, longer term indicators in our direction, in this case it's the cycle indicator. Again, this can be the momentum indicator from course 2 students as well. So we enter one tick below the low of the bar that created the hook, then we look for confirmation on the next time frame. If that's in line, we go short. So it just makes sense that if you get that setup in the opposite direction, cycle low, one tick above the high of the bar that created the hook up, and confirmation in the next higher time frame with a mini divergence, it just makes sense that, hey, well, now we've got a trigger to go long, and so shouldn't we be out of our short? Now, the one caveat there is that we don't really have a structural setup. In other words, we're not in an uptrend. We're still in a downtrend. But we understand that the market, doesn't always wait for trends. In fact, it never waits for trends. It reverses before the trend reverses. And one of the first indications of that is a shift in momentum. It doesn't always result in a reversal trend, but that's what often happens before a trend reversal. So, playing it a little on the safe side, it makes sense that when we get the almost exact same setup, at least with regard to our cycle indicators, going in the opposite direction of the direction we're already in, it makes sense to get out just in case. And so that's what that first trailing stop rule is. We're basically using our %D over here on the longer term time frame as our trailing stop. And you can also use %K, because %K can be a leading indicator of %D. And so you watch for that. Basically, you're just looking for an indication that you get a cycle bottom coming in on the longer term chart. That's the key. So just to make this hopefully painfully obvious, what we're doing is we're treating a cycle high on the short term as our entry and using the cycle low on the long term as our exit. So that's where our risk reward comes in. Our risk is defined on the short term chart, and our reward is defined on the long term chart, meaning we're not going to get out until on the long term chart we have a pretty good indication we've put in a cycle low. Okay, so that's where the risk reward is figured. Okay, so that's really just technique number 1 as a quick review. A couple little additions, clarifiers there. So the next rule for a trailing stop that we could use is when structure is broken. So again, we're looking at higher highs, higher lows, that sort of thing. So you could put your trailing stop above this high, say, well, we've got a little cycle high here, so when that high is broken, I am out. and you just move your trailing stop one tick above every cycle high that's put in. So when we enter, our trailing stop, of course, is right here. And this is one of the downsides of this approach, is that there's a couple of downsides to this approach. The upside is it's a looser trailing stop than using your long-term indicators or trailing stop. So you sometimes will stay in trends longer. The downside is that, again, I've got to wait until I have that next cycle high before I can move my stop down from my initial stop. Then when I get this one, then okay, and now that's coming down. Now I've got my cycle low here. Now I can put my stop in there. See that? And again, it's imperfect, because what happens when you get an ABC pattern? This is an ABC. What is this actually? Let's analyze this. Boom, boom, boom. Okay, A, B, C, and it just goes. So this is a little consolidation pattern. It's actually a little megaphone type pattern. And so you get stopped out here, and it does actually make a little bit of a lower low, but really the stop was good. It was placed appropriately in that your structure was broken. You went from a clearly downtrending lower high, lower low pattern to a megaphone, which is a bit of a chaotic pattern. And so therefore, the reason you were in lower highs, lower lows is no longer there. It goes back to our principle of the reason you got in is no longer there. Therefore, we should be out. It makes sense. Whether the market continues to go down or not is not important, because there's no way to know what the market will do from here. The point is, we've gone into more of a chaotic structure that no longer is continuous with the reason that we first got in. Therefore, being in a more chaotic environment, good to get out, stand aside, wait until there's a clear structure again. Okay, so that is number 2. That is approach number 2. And then the third one is dealing with the reality that most of the time the market does not go into megatrends. Okay, so before we move on, let's even take a look at this. So here's an issue. Here's our cycle high. Okay, here's our cycle low. A mini divergence there. Divergence in, divergence out. Okay, entry, exit. Now, the problem is, of course, we've got to wait until this bar hooks down, and then enter one tick below the low of the bar that created the hook, which means we're really not entering until here. And then if we're going to get out above this high, we're not getting out until here. Now, what do you notice? Well, this is our profit. Whoops. That's our profit zone, right? That's it. It can be deceiving because it looks like, oh, I'm getting in here and I'm getting out here. But you're not. Those are the highs and the lows. You're getting in here and you're getting out here. And so what is your real risk-reward ratio? Well, your risk was up here, so really that's about a close to 1-to-1 risk-reward, maybe even a smidge less than that in reality. So this is the problem with trailing stops in general, is that most of the time the market does not go into a big trend, and therefore if you use any type of trailing stop, you're allowing the market to move back against your direction, and so therefore you are really just taking the middle, your profit is just the middle area out of if it turns out to be a rather short move, and therefore your risk reward turns out to be crummy. So how do we deal with that? Well, the way to deal with that, according to my money management technique, is to have multiple exits. The first exit will be a support, or in this case, a support level. And when we come down to the support level here, and what is that support level? Well, it could be a Fibonacci level, it could be yesterday's low, it could be yesterday's close, yesterday's high, it could be a floor trader's pivot, Fibonacci retrace, Fibonacci extension. That's a whole nother discussion. But any of those are good support levels that I just mentioned. Those are the most common ones. It could even be a previous cycle low. Okay. So what we're going to do is we're going to just cover our short, half of our position, as we come right into that support level. And we're not going to use a trailing stop on half of it. So if I'm trading, let's say this is futures, I'm trading 4 contracts, okay, and I'm short, I'm just going to cover and buy back 2 of them here. Now what's that done? That means this is my profit zone. See, now I've changed my profit zone dramatically, and now it's 2 to 1 to 3 to 1. Because the odds are, again, knowing the odds are that the market will not slice through a support level on its first try. It will take at least 2 tries, sometimes 3. And the odds are this will not turn into a long continued trend. Those are the odds. I'm sharing with you what happens most of the time. And we can't play the exception to the rule, we got to play the rule. So that's why our first exit is always just buying into support and selling into resistance without a trailing stop. The only stop we have is that initial stop right over the cycle high. Okay, then after that is reached and we put in our next cycle high, then we do employ a trailing stop to see if when the market does make a big move, we can capture more of that. But if it doesn't, our trailing stop, is going to give us maybe a 1-to-1 risk reward. In our initial exit, buying right into support, it actually gave us a 2-to-1 risk reward. Sometimes it'll just be 1-to-1 as well, and it'll just be a 1-to-1 trade all across the board. But the point is, this is where your probabilities lie. Okay. Let's pull up a different chart and look at another option. Okay. Now here's another one that I use quite a bit. And it's basically using a you could do this a couple of different ways. A 2-bar swing is really, really good. Or even a 2-bar trailing stop. A 2-bar trailing stop is pretty tight, and so if we're going down here, come up, whatever, it just means that every time the market goes down, so for example, actually let's start this over. Okay, so if we're here, my stop will be 1 tick, 1 penny, 1 pip above the high of this bar. When this closes, after this bar closes, then I just move my stop back above the high 2 bars ago. Okay, or you can, yeah, that's right, after this closes, 1, 2. So as we're on this bar, okay, if this one's live, comes back up, goes back down. Okay, when it goes back down here, then I move my trailing stop to this bar, here, that bar, here, that bar, here, that bar, here. It stays there. Oops, 1, 2, I'd be out now. So that's what's called a 2-bar trailing stop. It's just simply counting 2 bars back and moving your stop. And you can choose any number you want there. I mean, I did it with the live bar. You could say, well, with the live bar, 2 bars back, or after the closed bar, 2 bars back. Some people use a 3-bar stop. There's no magical number, folks. There is no best. It's just a matter of, again, how closely you want to trail it. I don't care what number you choose. Sometimes that number will work out beautifully, and other times a different number would have worked out better. just the way it is. And which number will work out better this time? You don't know. Okay, so be consistent, though, is the key. Choose a number, stick with it, and generally I use 2 bars. But here's mostly what I do, actually. Rather than just a regular 2-bar stop, I use what's called a 2-bar swing trailing stop. So this is slightly different in the sense that you're not just moving at every 2 bars, but what you're doing is you're waiting. Here's what a swing is. Okay, that's a swing. And what it means, a 2-bar swing means you've got to put in basically, I'm just looking for this pretty much, this scenario right here. Let's just do it like this. That's it. So lower low and then a higher low that closes. And that's pretty much it. And you can do more than that if you want. You could do this scenario. Then you've got to wait for 2 bars to make, actually you have, 2 higher highs. 2 higher highs. 2 higher lows. Just individual bars. Okay, now I've created a little indicator here that plots the blue dots, and so that makes it a little easier. And that's it. So I know where my trailing stops go when I use this. It just goes 1 high above, or 1 tick above the high of this bar. Okay, we don't get it until here. Don't get it till there. Don't get it till there. This really works beautifully when you get this type of move. Now, see, this would keep me in on this whole thing because my stop's here, then it's there, 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 then it's there. And so this looks great. And it is great. You say, oh, well, I'll just use that one. Yeah, it's great because of this type of a move. In the market, it moves parabolic down. If you're looking at this on a minute chart, it's a parabolic move. So it works great for that. Okay, and it works okay for this, but look what happens here. This looks good, good, good. Oops, not so good. We took out these lows just barely. And so again, there's always going to be places where you'll find, oh, that didn't work out great. Maybe what I should do is wait till the K gets down to 20 and then use that one as my trailing stop. Well, again, this scenario worked out good. Others will not. Good. Yeah, here's one. So again here, good, good, good. And then you break that high, and then it goes down. Have a big move down. So I always have this on my chart because I do use this a lot, but none of it's perfect. None of it's perfect. So, having said all of this, what is the perfect answer? Okay, well, obviously, if you haven't gotten it yet, there is no perfect answer. So, what is the best answer? Well, for me, at least, what I have come to is this. And let's actually clear some way here and do a little typing. Okay, so here we are, again, to hopefully add some clarity. Now, these I've listed as we are going short, because that's the examples that we've used. Obviously, same thing applies going long. You just reverse all of these rules. So here are some trailing stops. Midterm, MT stands for midterm, middle term, and short term, cycle lows occurring at the same time, and then you get a trigger to go long. In other words, the longer term cycle indicator is going up. The setup chart that you're trading on, looking for the setups, that's putting in a cycle low. %K is hooking up. The price breaks the high of the bar that created the hook on your short-term chart to go long. And so everything's really set up to take a long trade, but you're short. So what are you going to do? Well, that's where you exit. You may not stop and reverse, but at least you're going to get out. That's one choice. Second choice, put your trailing stop one tick above the high of the short-term cycle highs as you're going down. And if you want to use a really, really wide trailing stop, you could even put it above the cycle highs on the next higher time frame. If you're a swing trader, see, think what that means. You're putting your trailing stop above the cycle high on the weekly chart if you're using your daily chart for your setups. And then you could also use a 2-bar trailing stop. That's if you want to go to the opposite direction and you want a really tight trailing stop, 2-bar trailing stop. Of course, you could even do a 1-bar trailing stop. Just put it above the high of the very previous bar. You can do that too. That's really, really tight. And what I prefer is the 2-bar swing high. And I showed you where that is. That's where just the bar itself goes up and makes a higher high, and then you get out on the second one. We actually wait for it to put in a little higher high. And then, of course, we also talked, it's not truly a trailing stop, but we talked about in order to maximize your risk reward most of the time, knowing the market doesn't make big trends most of the time, just go ahead and take off half your position right into the first major support you come into. So the optimal, getting back to the optimal way to do this, it's managing your money, meaning you've got to be trading a little bit of size. You know, every once in a while I get someone who emails me, but I know they represent a ton of people out there who say, well, I only trade one contract, so what do I do? Well, the truth is there's no good choice for you. You know, in my opinion, you cannot manage your money well. You cannot manage a trade. You don't have anything to manage. All you've got is one contract there, so you will never be able to trade optimally with one contract, in my opinion. You know, big traders don't make money on one contract. That's one of the reasons they don't do it. So if you do that, you're just, gosh, you're really limited to scalping, and it's just a tough way to go. I don't know how you can really be profitable trading one position at a time. It really comes from mixing up these various trailing stops. So what I recommend in my course, as you know, is to take half of your position. Let's say you're trading 1,000 contract or 1,000 shares of a stock, and I'd cover 500 at the first support, and then allow the market to bounce, because that first move into support, it's very likely the market will bounce off of that, and see what happens. I would have my next stop would be either at using that first trailing stop. In other words, if that medium-term cycle indicator hooks up and or momentum hooks up, and I get cycle lows occurring on both time frames concurrently, and I get a trigger, for a long setup, yeah, I'm definitely getting out. I mean, I will get out of at least half of my remaining position, which is a quarter of my initial position, or maybe all of it, because the rest of my position, remember, the rest of the position, its stop is still at that initial cycle high where I got in. It's above that. And then if I want to, depending on how many contracts you're trading, how many positions you are, how many shares or whatever you're trading, you can mix up a combination of these. 2-bar trailing stop is pretty good. 2-bar swing high is a pretty good one to use, especially for a parabolic move. See, again, they each kind of have their specialty, but parabolic move is a very vertical move. When the market's moving down, 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 and it's just screaming down, and you're saying, wow, this thing's tanking, usually after some news or something like that. You say, gosh, this thing's tanking, I don't know when I should get out of this thing. Well, this is actually a scenario when the market will quite often slice through support, because it is moving down so fast, it will not stop right on that support most of the time. Most of the time it will slice through it, and you can make more reward out of that than by just taking off contracts right into support. It usually will not stop on it. But it will normally still respect it. What happens is it slices through, falls like a knife, and then it kind of comes back to that support level. So this is where your 2-bar trailing stop, your 2-bar swing highs come in and are most effective in those type of scenarios. Otherwise, in a normal sine wave type scenario, can't tell you how valuable it is to buy in support, sell into resistance. That's, to me, always the right thing to do. That adjusts your cost position in the trade, makes a huge difference. And then from there, I'm using my longer term indicator as a trailing stop. I'm using cycle highs as my trailing stop. And so that's pretty much it. So again, this is why I like to trade in divisions of 4. So in other words, let's take it to the futures market now. In the stock scenario I used, we'd have 1,000 shares. We take off 500, and then we'd use 2 of our other trailing stops to take off 250 and 250. In futures, we'd have 4 contracts or more, obviously. You could trade 3 contracts and do 1, 1, and 1. You could do 2 contracts. So you're a lot more limited, of course, but at least you can buy 1 contract into support and then use the other one with your trailing stop. But it just doesn't allow you to capture as big a moves. If you're able to trade in multiples of 4, then you could take off 2 at support, take off 1 more with the next cycle high, and then you got 1 last one to hang in there for the really big moves. And again, don't count on those big moves. Don't build your whole trailing stop scenario around trying to catch the big moves. You'll get very frustrated if you do that. You know, I was even on the phone with a guy the other day, and he says, "Well, we had a big move yesterday." And I'm like, "So?" You know, there's going to be a couple of big moves a month, and that's nice when we get them. You know, try to tell me that, you know, before the day starts which day it's going to be, and nobody can do that. So you got to trade with the odds, with the probabilities, what's normal. Cannot trade the exception. Got to trade the rules. All right, hopefully that's been very helpful for you, and I wish you all the best.